Good afternoon, everyone, and thank you for joining us for this episode of Keeping It Simple with Simplify. We are delighted to welcome Gary Stringer, who joins us from Stringer Asset Management in the great Bluff City of Memphis, Tennessee. So Stringer offers investment portfolios and can be accessed via mutual fund or through separate accounts on various national platforms like Envestnet, Raymond James, RBC, and other platforms. For more information, please visit stringeram.com. So Gary is joined by our resident experts on all things. First up is the Convexity maven himself, aka Harley Bassman, who is a lover of all animals and creatures, large and small. And Harley is joined with Michael Green, aka Professor Plum on Twitter, who is traveling today and joins us from California's Central Valley oasis of Fresno, California. So today we are going to be discussing convexity and how it might be used to transform portfolios in these very strange times in which we are finding ourselves. So this discussion is meant to be for entertainment, hopefully, purposes and informational purposes only, and should not be taken as investment advice. We're going to save a lot of time for Q&A here, so we want audience participation. So if you look down at the bottom of your screen, there's a Q&A button. So submit any questions there. Some of the questions you will be able to answer kind of live on the fly. Others will stop and ask directly. So Gary's going to start us off and give us a little bit more information about Stringer Asset Management, and then Mike will take it over and give us an overview on convexity and some of his macro thoughts.
Right. So just to give a little bit of context about why we use these types of strategies, Stringer Asset Management is a global asset allocation firm. We implement our strategies across the risk spectrum utilizing ETFs. We as a group always managed money alongside financial advisors at various regional broker dealers. So we've always been sort of a partner to the financial advisor in helping them help their clients reach their goals. It's why our motto has always been, your success is how we measure ours. If we tend to develop deep relationships, long-term relationships with advisors, helping them to help their clients. And that's really where we get the value out of our sort of professional value. The process that we drive, because we're working specifically with advisors and individuals and families, our approach is very much behavioral finance related. In that regard, there's a few things that we pay a lot of attention to as we talk about our process that involves what we call 3 layers of risk management. Our strategic allocation, everything that we do contains these 3 layers. There's our strategic allocation, which is our longer term view, where we look out 3 to 5 years for our broader contextual view. We also have a tactical allocation, where you'll see more of the activity in what we're doing, emphasizing certain themes like sector themes, countries, regions, commodities, or to hold cash from time to time tactically. And then there's our cash indicator, which is a quantitative methodology that overlays everything that we do that could allow us to signal us to take the portfolios out of equity to 25% cash or even 50% cash coming out of the equity side of the allocation. It's these 3 things that work together that develop over time that risk-first approach. And that risk-first approach is super important to us. Again, think about behavioral economics here. Behavioral economics teaches us that downside volatility matters at least twice as much as euphoria of a gain. And you can have great long-term track records, but the client's not there. If the investor panics in the middle of it, they're not there to experience it, then we didn't really do our job. So everything that we're doing is to try to help the advisors help their clients achieve those long-term goals. And so with that as a context, everything we're going to talk about today kind of fits in that as we talk about different strategies to help manage volatility, help clients stay the course. And again, a lot of this is expected behavior, right? Most of the people that we're working with are not institutions that have infinite time horizons. They are families that are approaching retirement or approaching some financial goal, like paying for a child's college, that type of thing. And so it's a whole different context. And that risk-first approach is what really helps people stay the course.
So when you think about this dynamic of a risk-based approach or how to protect a portfolio, one of the things that we spent a lot of time talking about before we hopped on the call, Harley was asking some really good questions. I'd love to reintroduce some of that conversation. But is this idea of you have to ultimately stay invested in some way, shape, or form. Now, you have a mechanism that allows you to take people to cash if you receive particular signals. But in any sort of timing component, there's also an element of uncertainty, right? So you can't be certain in advance that that's going to happen. And so one of the ways that I think about portfolio protection is that you want to have an element of it always in place. What's your thought process there, Gary?
Yeah, that's exactly right. I was saying that each of these three elements works together because you're never going to be right, perfectly clairvoyant, right? And timing perfect all the time is impossible. And so it's always important to be thinking about risk management in each of these cases. So we absolutely do have parts of the portfolio strategies on our most aggressive strategies all the way down to our most conservative strategies that are always there, some kind of volatility hedge to try to attempt to stabilize in uncertain times. So that's always there. So it's not like we're going to be, full on market beta one day and then off the next day. We always have some volatility management in place strategically. And then we will from time to time include it tactically. And then of course, if the cash indicator goes off, we'll just hold cash.
So when we talk about this idea of convexity, I'm going to flip some of the slides that we have here and this idea of what convexity actually is, right? So convexity in a mathematical sense is a relationship that has a positive second derivative. In other words, the rate of change is increasing with each change in the underlying, right? You can see this on the chart that I'm sharing here, where we're looking at two different types of convexity. Negative convexity, which would be consistent with something like a bond, in which case they get worse and worse the more extreme the market goes. The extreme version of that would be something like a short straddle, where you have sold calls and you've sold puts with the hope or the objective of earning an excess return in a small environment. Randy Woodward in chat jumps into the callable bond type framework, where if things do really, really well, it gets called away from you and they refinance into a lower interest rate bond. On the positive convexity side, and this is where you tend to seek out the protection, you're looking for something that has the ability to offer you protection in a runaway market with the top side. Effectively, a call option would be a good example of that, a long call. And to the downside, the obvious protection that most people think about is a put. Right. So a long straddle is the reverse of a short straddle position. That pays off in both directions. Right. Now, the reality is that there's all sorts of ways to try to get around the fact that protection costs you money. Right. And one of the most common has been things like US rates. Right. So bonds, risk-free bonds have provided protection because you have actually had conditions under which when risk-off events occur, the Federal Reserve cuts interest rates. That causes bonds to rise in price and increases a portion of your portfolio that can then be redeployed into the riskier assets, right? That idea has worked out great for give or take the last 40 years, and in particular since 1998, as the Fed began to very aggressively use interest rate policy to target risk-off events. There's other ways that you can try to do that. One of the ways that people think about protecting portfolios is actually on the short selling front, right? So theoretically, I can buy stocks that are going to go down, right? Now, one of the things that's interesting is actually short selling doesn't have a truly positively convex payout for a very simple reason, that it has a credit feature to it, right? So when all hell starts to break loose, we saw this in its most extreme form around the events of the global financial crisis and Lehman. Those shorts can actually result in tremendous stress on balance sheets, right? And you effectively have those positions pulled away from you. You're forced to short cover because you've lost your margin accounts at the worst possible time. So that's one of the reasons why, my focus has always been on this dynamic of, you want to make sure that you minimize the basis risk associated with it. The basis risk meaning that it doesn't do exactly what you want it to. And that for me is one of the reasons why I'm always drawn to the dynamics of protection via puts, right?
Mike, can I push back on one question here?
Sure.
I mean, going back to that chart, it makes it look, we call this, we talk about smile sometimes, but I mean, there is the thought of, no bad bonds, just bad prices. I mean, it is the case where convexity can cost way too much, and being short is a better idea.
I think that's absolutely correct. It's one of the reasons why you've seen us introduce strategies that involve shorting the extreme pricing components associated with convexity, right? So long options occasionally, and actually far more common through history, right? Being long convexity traditionally has actually had a negative return associated with it, right? We're all familiar with the language that 85% of the time options lose money. That's a little bit too harsh, right? That observation is a little bit too harsh, in part because the vast majority of options are purchased for hedging purposes. And so it's another way of saying that 85% of insurance don't pay out. Well, I'm perfectly happy when my car insurance doesn't pay out or my house insurance doesn't pay out, as long as I didn't have an incident that required it to pay out, right? So if my house burns, what's up?
And all that fact ignores a small detail that many option longs are delta hedgers, but we're not going to go into that.
Well, so again, it belies the question of when you say who is on the side of the trade, right? So 85% of options lose money. The vast majority of options are bought as an end use for a insurance purpose. For those who are actually in the market making business, et cetera, who may buy an option because you want to sell an option, they are actively synthetically replacing that option. You're talking about the delta hedging dynamic, right? They're just trying to capture the difference between the implied and realized that they've marked up on you. Now, where it becomes really interesting though, and this again goes back to kind of the question that Harley and I were discussing beforehand, is are there reasons why convexity can pay off, or why you actually want to, one of the questions is asked, why do you not want to just diversify, right? So there's actually very valid reasons why you would seek protection in one form or another. Among them is the fact that investor needs are not homogenous. And so we're all familiar with the checkboxes in portfolios that you'll see in a 529 or in a target date fund that say, when are you planning to retire? Or when do you have this major purchase ahead of you? And when you have those types of events, you may not actually want to sell because you don't want to incur the tax. You don't want to take the money out of the market, but you're willing to accept a lower return in exchange for greater certainty, maybe not absolute certainty in terms of the terminal value of the portfolio, but greater certainty. And on the top right of this chart that we're looking at here, we're actually looking at the distribution of the US population in terms of its aging. And one of the things that we all know very well is that the boomers are rapidly approaching their retirements, right? If not in it already. And in many situations, the vehicles that they would have historically used just can't offer the sort of returns that they require, right? Gary, I'd be really interested in your thoughts here in terms of, how might portfolios have changed versus say 1990, or even 1999, when you could have gotten 5.5 or 6% on a US Treasury. Today, we're looking at, 1 and change, well below the inflation rate. That's a pretty tough place to say, okay, you should be going 60, 70% into bonds.
Absolutely. I agree with that completely. And it's important to understand how that, so when you're thinking about portfolio management and developing these sort of return expectations, there's a risk expectation and there's a return expectation. And for us, when we're developing long-term forward-looking returns on the equity side, our favorite tool for that is looking at the current earnings yield. And then that gives us an idea of what we can expect going forward. On the fixed income side, we like to use yield to worst. And both of these, earnings yield and yield to worst, right now are off the charts low. So when you think about what you could expect from a total return on a 60-40 allocation 20 years ago, or even 10 years ago, it's far different than what we would expect today because the markets are so much more expensive. In fact, it's on the equity side anyway. The fixed income side is different, but on the equity side, it's not unlike when, do you remember the lost decade that came out in 2010? It was the lost decade because the start in 2000, the valuations on the equities at the tech bubble were outrageous. So of course your forward expectation should be for low return. Today, we're seeing kind of similar valuations on the fixed income side, where at least back then you had higher yield, so your forward return on fixed income would be higher. Now our forward return expectation on fixed income is near as low as it's ever been. It's only popped up recently because rates moved up from 50 basis points last year.
Yeah, no, I think that's right. There's just a quick question of clarification. The definition of yield to worst, Gary. So I want to make sure that people understand when we refer to yield to worst, that is basically saying what is the yield for a bond to either the point that would be called away or that the bond would mature, right? So you're the yield to worst is basically creating conditions of saying, is there a risk that this bond could get bought from you at, say, a premium price of 110, right? Is there, okay. And so when you think about, and somebody just helpfully provided the link. So when you think about that component, right? So the return and the risk component and managing that, there's another reason, and this is tied to my research in terms of the changing market structure, why you might want to seek convexity in a portfolio. And that's if you actually think that the options are mispriced, right? And so there are ways to evaluate that. On the chart in figure 3, this is referring back to a case study and thought piece that we recently put out. It's thinking about, how are options priced on a fair basis? And the structure of how options are priced, the strike price on an option is not the spot price. It's not today's price of the S&P. It's the forward price. And so what we're looking at here is a study that we did on the behavior of the actual outcomes in markets relative to what was priced into the forward. Now, a market that's quote unquote fair should have the forward, right? The forward return basically match the expected return, the forward, right? And what we're seeing is that there's a dramatic shift that's happened in two directions. One is the frequency of positive expectations or positive experiences is rising. So we're actually seeing effectively, people have heard me use the phrase, the roulette wheel is imbalanced. Instead of stepping onto the roulette wheel and black and red being distributed roughly 50-50, it's coming up, give or take 70-30 black. That creates conditions under which you can structure a trade in options that has positive expectancy. On the other side of that equation, you can see this in the solid orange line, the incidence and frequency of severe negative outcomes is also rising, right? And this feels very much like we experience in the markets. Harley in the past week has been, pounding the table. It's like, how is this market marching up every single day, right? How does it not retreat? Right. And then yet we know that March 2020 happened. We know that the fourth quarter of 2018 happened. We know that Volmageddon happened, right? These are extreme events in the history of markets. They're happening with greater frequency. Now, the great irony is, of course, the dashed yellow line, which is what we've seen on a year-to-date basis in 2021, right? Which is basically, we are the luckiest. We've seen no real incidences of significant left tail events yet. My hunch is that's not going to continue forever. Harley, you want to add anything here?
No, I think you're doing a fine job, Michael.
I'm so proud of myself. Thank you. So the question actually just came in, and I do want to hit on this, is this idea that, aren't these opportunities to add? And that's absolutely the point. And it's exactly the reason why you want to hedge this scenario, because what you're doing when you hedge this scenario is you're creating cash in your portfolio. You're creating the same thing that we're describing with a bond. So if you own a put and the market falls, that put rises in value, you can sell that put and reinvest it into additional equity exposure at a much lower price. That can enhance your returns. Okay, so now why is everybody worried, right? Because clearly markets only go up, as Harley has pointed out in the last week in our internal chats. And the answer is basically along the lines of what Gary was hitting on, which is we're looking at a situation where the metrics that historically have composed return of portfolios are among the least favorable we've ever seen in history. Right, we see that in the form of long-term interest rates hitting, multi-thousand-year lows. We actually have a chart that will show this in the millennial characteristic, but also in terms of the valuation of the equity markets themselves, right? And so you actually see this in terms of why should we be concerned? Now, I have no idea what's actually going to happen going forward. Neither does Gary, and Harley probably does, but he's not telling us, right? So we're faced with a situation where the only thing that we can actually do is hedge our portfolios against the scenarios that we're worried about. Now, a lot of people are worried about the right tail, the idea that inflation could run and that things get absolutely out of hand and that the dollar that you own is worth much less. So that's one of the reasons you might seek out right tail hedging. Chris Cole, in his 2012 paper, The Alchemy of Risk, actually hits on this dynamic with extraordinary precision. When we look at markets that have experienced high inflation or hyperinflation, it's relatively uncommon for asset prices to move to lows, right? Simply because what's happening is you're losing value in, it's unlikely to have the left tail there. You're likely to have a right tail outcome where prices rise, but the money you receive back is worth a lot less. The more common scenario that we've dealt with in the past, roughly 3 or 4 decades in the United States, and really in the United States, we've never had a true hyperinflationary environment past the Revolutionary War. You're looking at a situation where that protection of the left tail becomes particularly important. And again, when I start to think about the structure of our industry and the way that we're built, one of the frustrations that I experience is that portfolios are built for those who have money, right? We design portfolios almost working in reverse, saying you're going to retire at 70. 69 is just a year before 70, and 68 is the year before 69, and 67 is the year before that. And we work backwards into portfolio construction. That actually works really well once you're an established investor and you have a nest egg to protect. But there's also this underlying question of what do you do if you're a younger investor and you want to take additional risk and seek it out? And I think one of the things, Gary, we talked about this before, is this idea of, are there actually appropriate portfolios for younger investors? Is it the right way to think about it? Just start at your retirement and work backwards? Or do you think maybe there's an opportunity for thinking about taking more risk and building portfolios for those investors that are slightly different?
We do think there's an opportunity there, because you're exactly right. With with our clientele for our business, it is primarily those baby boomers and people who are at or near retirement and focused on the risk of a decline, because they can't, they don't have 20 or 30 years for this thing to come back if they do take a massive loss, right? But there's a massive your demographic slide showed it. There's a massive cohort of millennials who are now starting to approach their earnings years, and they do have time to wait if things do go badly. But also, if you're starting in an environment where valuations are such as they are, they're stretched, and your outlook for equity returns going forward is going to be limited, anything you can do to help them get up that ladder a little bit more quickly, I think there's a great opportunity there.
Yeah, I tend to share that. Actually, I'd love to introduce a personal anecdote from Harley. Harley, maybe you could share the advice that you give your kids.
Which one's that?
Wow. What
many of them.
What do you suggest in terms of the instrument that you've advised your kids to buy?
Oh, the in the money calls?
Yeah.
Okay. It's if you have millennials, like I have 4 of them, I mean, I'll dial back 1 second here. The key thing about convexity options is it's a path dependent risk. It matters how you get there. Whereas duration or credit or just the stock market itself, if you buy on A and if it goes up 10%, it doesn't matter how it got there, you'll be up 10% come year end. Options are a different animal. And that's a consideration to make with all the products we're dealing in here. With my particular kids, they were looking at, they're 30 years old, they're putting money away and they ain't selling no matter what. They're hodlers. Doing a little yo-ho also, but they're hodlers and they're going to hold for 30 years. And they were looking at buying one of those 2X or 3X ETFs, which are extraordinarily expensive and efficient. And I said, you're better off just buying for SPY, a 100-point in the money call out for like 2 or 3 years. And you could buy 3 times as much of that as a regular cash investment and put that away. And that is rather clever because it locks up your borrowing costs, it locks in your dividends, and it locks up your profile and gives you an embedded out of the money put in the game. So, and we have products where we apply this technology also right now.
Yeah, so I don't want to focus on that, but that is absolutely correct. So again, if we go back to the chart that looks at the convexity component, effectively what Harley's describing here is a trade where you are buying an in-the-money call option. If your objective is to continually invest, if you're making a contribution every 2 weeks or every month, particularly as a younger person who has less capital in the game and more human capital, so less financial capital, more human capital in the game, one of the best strategies that you can pursue is to focus on that right tail. And I'm 100% convinced that part of the nonsense that we're seeing, and I apologize for offending people in that, but a lot of the nonsense that we're seeing with the crypto and hodling, et cetera, is a younger generation who is desperate for a more levered, more aggressive, more right tail oriented investment strategy. And this is a theme you're going to hear me return to over and over again. I do think that it is really, really important for us as financial professionals to stop and think about the fact that they're trying to communicate something to us. And we're by and large looking at them and saying, you guys are nuts and crazy. And I think that's really, really important that we recognize that that exists out there. Now, on the other side of that, though, is what we have benefited from that has allowed us to seek out this leverage, right? So somebody in the chat picked this up and pointed it out that in roughly 1997, we changed the correlation of markets, right? So historically, bonds and equities have an uncertain relationship. Higher interest rates, which lower bond prices, are theoretically supposed to be bad for the discounted cash flow characteristic of an equity. But depending on why the Fed is cutting interest rates or why the Fed is changing interest rates can have a meaningful impact on that relationship. So prior to 1997, the Fed was largely focused around taking away the punch bowl, using interest rate policy to reduce their threat of inflation, to slow the economy down. Right? This is a legacy of the events that occurred from the 1966 period where inflation rose and the central bankers found themselves behind the curve in terms of fighting that inflation. They effectively overreacted throughout much of the 1980s is the way that I would interpret it. We ran unnaturally high levels of real interest rates in the 1980s and 1990s. And following the Asian financial crisis and long-term capital management in 1997-98, the Fed dramatically changed its policy, primarily focusing interest rates on protecting assets, right? So in that event, what we began to see is a change in the construction. Now that had a really interesting impact, and other people may have heard me talk about this, but it effectively created the Fed put, right? So if the Fed is going to cut interest rates every time risk assets take a tumble, then by owning bonds in my portfolio, I'm actually benefiting from that. I'm owning an asset that is going to go up in a risk-off event, and that gives me additional assets. It's the same as that put that I described before. The risk that we have today is that with interest rates as low as they are, it's not at all clear that that policy can continue for much longer. And Gary, I'd be interested in how your clients are thinking about this question of can the Fed put maintain itself?
Yeah, so our investors, again, tend to work with individuals and families. So they're not going into it at that level. Their real struggle is they use the income side of the equation to generate current income, right? And as they're looking, a lot of these folks were in their formative years in this late 70s, early 80s, when interest rates were significantly higher. And for them, it's less about the risk side of it. But what do you mean I can't go out and find a 6% bond that's, municipal tax free? That's, a 5-year duration or something like that. And so it's that kind of conversation about, okay, I'm trying to get to that. If we think about sort of that 4% kind of income that people are looking for in retirement, you just can't get there with the bond allocation these days because interest rates are so low. You might be able to get there with the equity side, but remember, equity always brings in that risk. Right.
Yeah.
Now, equities are going to be volatile. So if you're going to go down that road, like a lot of people we talked to got smacked with that last year with equity income strategies that suddenly were down 30%. And they're still trying to climb out of that hole. And so that's where tools like this, strategies like this come in because you can't count on that kind of income that they're looking for. So they're going to tilt it more towards equities, but you still can't stomach all that equity volatility and equity market risk.
Yeah, and you hit on a really important point. So you didn't pick 4% at random, right? So 4% is basically the required level of distribution coming out of a 401k or out of an IRA. It rises obviously with age. And that is the rule of thumb for spending. It's actually the legal requirement for most nonprofits, et cetera, right? The irony is that was set at a level that encouraged you to take a level of distribution, but you weren't supposed to be tapping into your principal as you save for retirement. Now we have no choice. Right. And so, we at Simplify, we've sought out ways to replace that income in prudent manner. There's vehicles that we've recently introduced that have characteristics around that. But this is going to be the real struggle for us. And the other factor I think that's really important here is if there is risk that this no longer functions to protect portfolios. In other words, if this correlation retreats back to an uncertain relationship, we've seen that deterioration occur in front of both of the recent significant corrections. We saw it fall in 2006, 2007. We also saw it falling in 2018. You can see the correlation drawdowns associated with it. It tends to create conditions under which one of the more popular strategies out there, risk parity, is forced to reduce its leverage, right? Because if they no longer operate in the opposite direction, the ability to run those highly levered portfolios where you've taken a small bond allocation and magnified it, that capacity is reduced. And this is one of the real things that I think people who are deep in the weeds on market allocation understand this. It's not at all clear to me, actually, that the central bankers think of it in this way. I'm not sure that they acknowledge certainly in the conversations I've had with them, they would not acknowledge the implicit protection for leverage that they have created with their policy choices.
I want to push back over here a second, Mike. I think
Sure.
we're confusing correlation and causation. This chart's very important. I mean, this is the most important chart, I think, right now. It is not the Fed that did action that created low inflation. What we have over here is this concept that when inflation is below, we'll call it 2.5%, bond yields below 4.5%, you get a correlation of stocks to bonds where they self-hedge each other. But if you get inflation above this level, bond levels above that level, you get the stock to bond correlation to flip around. And what I've been proposing, and Mike and I, wrestle about, is the notion that this correlation is going to flip because inflation is going to go up, not because of the Fed, not because of QE, but because of demographics. Demographics being that the inflection point between millennials entering the workforce and boomers leaving the workforce, either happily or in a box, is going to inflect between 2023 and 2025. And that is the big risk for the market, because if all of a sudden we have this concept where stocks and bonds don't go in opposite directions, like your 60-40 portfolio is not going to be so happy, but moreover, your levered portfolio is going to be really unhappy. And this is why we've chosen this 4.5% level as being a critical level to watch, and why I'm very concerned. I don't think the Fed has any influence at all on inflation per se. I think it's a demographic iceberg concept that's coming at us right now. And this leads into the other question of, Michael, what do you think, and Gary, what do you think about the flows right now of millennials putting money in, whether they're picking, GameStop or they're putting it into passive funds, versus the boomers who are selling, or at least forced to sell because of that? Is there one bigger than the other?
So I let me take a quick cut at that in a couple of frameworks. So first, I completely agree with you about the demographic influence, right? I also think that the role, and people have heard me talk about this before, the role of Paul Volcker in conquering inflation, et cetera, is limited. I do think that the Fed responds to that information set, right? So the Fed, this relationship, as you point out, reversed itself even as inflation remained relatively tame, and as the Fed first began hiking interest rates in response to inflation in the late 1960s. Whether that persists, whether the Fed chooses to react to inflation in the future, is uncertain, but what we do know is that that puts additional pressure on them. The pushback on the demographic side towards the type of inflation that we had in the 1970s is, even with the flip in the demographic makeup, we're still looking at dramatically slower growth in population and labor force. So while there is a modest uptick, the risk of capacity utilization being swamped is much lower. Now, the geopolitical angle, and this I actually completely think is uncertain at this point, whether we're in the process of replacing China in the supply chain with other sources, domestic sources, for example, that can absolutely influence that. And we're not going to know that until we play through that game. So I 100% support the idea that we are at a period of greater uncertainty as the direction of inflation. and the direction of those pressures. And I love the idea of investors seeking out protection against those risks after, 40-year bear market where we were increasingly confident and comfortable with the idea that interest rates would just continue to fall. But one of the things, actually, this is a perfect, I'm going to skip ahead to a chart and just show this, that I'd mentioned it before. This is looking at rates over 5,000 years. We tend to focus, because of the age of the people in the industry and our lived experience, we tend to focus on quote unquote normal rates being those of the 60s, 70s, and 80s. But if we actually look at the data that we have on a historical basis, like that's the aberration. The idea that we're going back to 15, 20% interest rates, that would really surprise me. It's possible, but it would really surprise me. I think the story that people tend to forget about the 20th century is how unique it was in terms of the explosion of global labor force and the competition for resources that created.
That's a straw man, Mike. All you need is rates to go above 4%, which is basically your average, to go cause trouble for the market. Who cares about 15%?
Whether it's a straw man or not, the question for me is how is that going to play out? I don't know the answer. I do know that we're looking at the 21st century as being amongst the lowest in population growth in any form of modern history, right? It rivals the period of the 14th century.
Look, you know what? I don't know if rates will go above where they are right now. What I do know is what will happen if they do. So I'm willing to stipulate that the odds of it happening are very small, but if they do go up, I know what will happen, especially with today's market, because the bulk of the S&P is these 70-year duration securities that'll be absolute toast at a higher rate.
It's going to be interesting to see. I'm less confident than you are, but we'll find out how that plays out. Let's flip back just very quickly on the last component, right? Which is the last couple of components. In terms of the changing market structure, everyone has now seen this slide a couple of times coming from us to simplify the dynamics of the co-movement or the propensity for the S&P 500 stocks to move in the same direction on the same day. I think this is just a very clear byproduct on the growth of passive investing. If you buy and sell stocks in mass in an index, they're going to behave more and more like themselves, right? Or each like the other. That sort of condition is creating part of the reason why I believe it's so important to seek out that type of protection, right? Because when everybody tries to sell, all the stocks are going to move down together. The ability to protect yourself in a long short portfolio, right? Or are we going to experience an extreme move in the S&P 500 or the broader market? In my opinion, the opportunity, the risk of that has been magnified dramatically by the character of how we've changed the market structure. And we're back to the yields. We're on the 5,000-year chart. And the last piece I would just hit on in this is this issue of like, what is the best way to protect a portfolio? So the quick answer is there is no best way. But what we are absolutely seeing is, and we saw this very clearly in March 2020, the historical protection that a bond biased portfolio would have created. And somebody else, actually, it looks like Rick Haynes brought in the idea of CTAs and convexity. The way that CTAs provide convexity is through the structure of effectively trend following, where you get more and more short and then reverse it. We're just not seeing that type of protection. March 2020 was a wake-up call where the Fed aggressively cut interest rates, and the real damage that happened in the March 2020 time period was after the Fed cut interest rates. The 10-year bond fell from give or take 125 to 33 basis points, and then was back at 120 basis points 4 days later, right? The reliance on that hedge, as distinct from a reliance on puts or other forms of protection, was devastating to the market. So that's where I'll stop. Anything you guys want to add before we open it up for questions? All right, Brian, let's open it up.
All right. So first off, our audience is terrible at following directions. So we've got a number of questions in the Q&A. So please drop any other additional questions into the Q&A. I'll start off with the first one coming from Chris. How do you create, kind of given all this is wonderful and very confusing for most people, but how do you create a portfolio that has positive convexity going forward?
So the question of how do you create a portfolio with positive convexity is ultimately boils down to, do you actually buy instruments that have convex payoffs? All right. And so this again goes back to what the definition of convexity is. If I'm looking at a chart with positive convexity, what I need is something that gains more rapidly than the overall market. So the dark blue line here is a market construction. You can think about this as being long a call. As the market rises, that call goes into the money, it picks up additional delta, and it rises faster and faster relative to the overall market. Eventually, that flattens out in the form of a call, where at some point out here, it flips back down and just begins to behave like a stock, right? So one of the ways that you're doing this is that you're buying something that's out of the money. The other way that you're doing it is you're adding leverage. And this is back to Harley's observation for his kids. And it's the same advice that I share with my kids, which is that you want to seek out a portfolio that has the ability to outperform on the basis of positive leverage, but effectively stop losing money at some point. The most you can lose if you buy an in-the-money call is the premium that you've expended. That's the most that you can lose. That's one of the benefits of owning those types of calls. There is no limit to how much money you can make. On the downside to a levered portfolio, so an in-the-money call, give or take, is roughly a 4 to 5 to 1 levered expression. And there's all sorts of components around that that are coming in commentary, except for counterparty risk. That's absolutely correct. But when you, which is why you focus on the exchange traded stuff. But when you actually think about what you're doing with a levered portfolio, say you're going 1.5 or 2 times levered, then you could actually theoretically lose more than 100% of what you put in, right? You're forced to meet a margin call. That has really unattractive prospects, because it effectively means that you are forced to sell at the worst possible moment at that low price, right? So it's the opposite of what Gary is trying to accomplish with his go to cash signal. And I'd suggest that most really good go to cash models have an awareness or a recognition of where the market falls when it starts to trigger those margin calls. There's a reason why people pay attention to how much margin is out there in the markets. We've seen this most explicitly in things like crypto recently, where crypto and many of the DeFi complexes, the decentralized finance complexes, those are just giant short straddle positions, and they've created forced liquidations of positions. And everyone points out that they're over collateralized and that nobody can lose, that the banking system can't blow up on an over collateralized position. And yet we've seen things like Titan go to zero very, very quickly and overnight, sort of sessions. That's the key risk that you run when you're running leverage, right? On the downside in the protection, the very straightforward answer is you buy puts. And it's the opposite of what we're talking about in calls. How you want to take advantage of that, to me, goes back to the underlying structure of the market and the expected return stream. And so then this takes me back to figure 3. The in-the-money call is non-recourse leverage that gives you greater exposure, gives you greater magnification of this positive expectancy framework that I'm talking about, right, that I've referred to and that Harley highlighted. That extreme left tail, that greater risk of the really extreme event, to me, that's the key risk in portfolios that exist today. That coordinated go-to-one correlation, real market crash. When you're faced with that sort of situation, to answer the question very directly, you want to buy those puts, right? So somebody brought in Nassim Taleb, the Universo approach before. The way that Nassim captures the premium to offset the cost of buying those tails is by selling other options, either a near the money put, so you're increasing the risk of a small drawdown, or by selling call options to fund it, right? And there you're giving up upside. For me, that's contra thesis with the structure of the market, where you have this dynamic of the calls are actually undervalued, right? You're seeing greater positive expectancy. So I don't like selling that. I'm a little more open to the idea on the downside, but then you're actually meaningfully magnifying the risk of a 10% sort of drawdown. And so I think that there's lots of different ways of approaching this. For me, I come back to the what my analysis suggests the underlying structural change in the market distribution is. That's how I choose to structure the portfolio components.
Let me add to that one thing over here. When you talk about a convex portfolio, what you're talking about is the speed to which you make or lose money. If you make or lose money one for one, up or down, that's not convexity. Convexity is about you make 3, lose 2, or lose 5, make 3. What I kind of think about, and so being convex on the downside or not convex basically means that I don't lose money at an accelerating pace. What you've seen happen in markets is people lose money at an accelerating pace. They lose $1 and then 2 and then 5 and then 10. Each move down, they lose more each time. That's what blows everybody up. So if you could avoid being short those puts, it's a winner. What I will do is this: I will go and create a portfolio where I'll live with the one for one downside. So it's not convex either way. It's just one for one downside, but I'll create positive convexity on the upside because the calls tend to be underpriced. They're underpriced because people are always selling them to capture income, whereas the puts are overpriced. People always buy them for protection. And if you can create a series of positively convex upsides, you can then put a little less money into the market, and so your downside is less. And then the other thing to consider is the correlation of those various assets. So you have the convexity of each asset class, and then add them together. Do they multiply or do they offset each other? And that's where my interest rate thoughts are focused right now. That if we do get higher rates, it'll flip correlations and be problematic. And that's where my in the money calls come in also. And someone asked about why that's an out of the money put. If SPOOS is at 4,400 for SPY, about the 300 put, 300 call, that'll cost you like, I don't know, 105, 108, something like that, going out a couple of years. That strike, that in the money strike, is owning a 300 strike put, mathematically put call parity. And so that's why I do that. And so I package the whole thing together, and I might own, 1.5 of those versus what I might otherwise do for owning a pure equity allocation. So it's basically, it's not an arbitrage, it's a better way of getting the beta you want. And so you decide how much S&P exposure do I want? What's the best way of doing it? So I'm not advertising how much you should buy, just how to do it.
I think that's actually a really important point. On you illustrated a couple of things with numbers that I referred to before, right? So if you're looking at the let's just make life simple and say that the SPOOs right now are at 430, you're buying $100 in the money call option on typically a 2-year duration, which tends to be the longest of the exchange traded component. Exactly to your point, that's going to be priced somewhere around $105. Right? Let's just make our lives simple and say that it's priced somewhere around $105. As the S&P moves higher, you're going to get one for one relative to the S&P, right? Which is giving you, because you're paying 105 versus 430, you're getting roughly 4-to-1 leverage, right? So relative to somebody else who has bought the overall S&P, you're getting that. But if the S&P were to fall to 300 or 330, you would actually still have value in that call option. And in fact, you would have actually seen the market risk factors, things like the VIX, should have risen dramatically, and the pricing of that call will have risen because of the volatility component as well. That's what creates that truly convex payout that you're referring to, where I don't need a lot for it to go up for me to break even, that 105 versus the 100 intrinsic value. But I also have protection to the downside beyond just the fact that I can only lose the amount that I put forward, right? So I'll lose less on the downside and make one for one on the upside on a more levered position. That's one of the things I love about that trade. I think it's just a great way for younger people in particular to think about it. Older people can think about it in the same way, but they have to invest less, right? Which frees up other things to do. Gary, you look like you're ready to chime in there.
I was just going to say, yeah, for one of the nice things about the development of the space, the ETF space, there's so many more products out there that you can conceptually do these things at a much more efficient level for the RIA to do it. I don't want to call it one-stop shopping, but there's more product out there. There's more ability to do that and to scale it for your practice. It's one of the innovations that's happened in the last couple of years, especially with the ETF space, that we really like as we're creating our portfolios, because we can do these types of things, and we're trying to capture more upside or hedge more and protect more, but we can do it quickly and scalable, tax efficiently, and at a relatively low cost. And so it's just, to us, it's a great, the innovations that have happened the last couple of years are fantastic.
And a lot of this, again, to Gary's point, I'm sorry, is the fact that the rules have changed that allow you to construct portfolios around this, right? So the introduction of the derivative rule has made it easier to incorporate these types of insights. I did want to hit on one last point. So Harley had mentioned earlier the idea of using a levered ETF, right? So products that are 2x or 3x levered the S&P could theoretically create this type of payoff structure, except for one issue. They continuously rebalance so that they're always providing the same degree of leverage, right? So by definition, somebody brought up the idea of volatility drag. That's part of it, but actually the bigger issue that you face with those is that they are perfectly symmetrical in both directions. Because they are continually rebalancing, they go up and they go down by 10%. The trade that Harley was highlighting, for example, with the positive convexity, has very different characteristics. It loses less as the market goes down, and it makes more as the market goes up. They're both levered expressions, but very, very different in terms of the implications for a portfolio construction. All right, let's go to the next question.
All right, so Mike, you talked about what has changed in the market, and as we're having the discussion of utilizing options to change return profiles, what would need to change in the market for kind of this inefficiency to go away?
Well, I think that there's two separate ways of thinking about the inefficiency, right? So there's the work that I refer to, which is the changing market structure. My analysis suggests this is just going to get worse, right? And a lot of ink has been spilled on the extraordinary inflows that have occurred into the markets on a year-to-date basis. Far less press has paid attention to where that money has gone, right? So a significant amount of money has gone into various factor portfolios, but the vast majority of this money is continuing to go into passive strategies. And as that continues, like, the market structure gets more fragile on my analysis. The Bank of International Settlements actually just came out with a piece 5 days ago, was flagged by our intern Shri, where they're highlighting the dynamics of ETFs changing the behavior of the market in a manner very similar to what I've discussed. I don't see that changing, right? So, while the Vanguards and BlackRocks and the passive vehicles are well below 50% share of total market cap at this point, slightly above it in terms of managed assets, on a year-to-date basis, I was highlighting this internally the other day, like roughly 60% of all the money that came into the market on a year-to-date basis has gone into Vanguard and BlackRock, right? The problem just gets worse and worse and worse.
Mike, hang on. Let's pick one point for people. When people hear the word negative convexity, they think of scary animals and bad things happening, which is generally true. But in this particular case, I think we should highlight that the increase in passive has created a more negatively convex profile for the market, both ways, up and down. I think when you say that, people think, oh, we can go down faster because of passive. I think you should highlight the point that you can go up faster also because of passive, because no one considers that. And that, I call it a feature, not a bug, if you want to create portfolios that own upside convexity.
I 100% agree. It's a great point, Harley. And it's one thing I think that kind of, I very much feel like a Cassandra at points trying to warn people about the problem, but I use the language, we're driving a car uphill with no brakes, right? Like, pedal to the metal, we're going fine. Nobody cares about the brakes until you start going down. Doesn't get anyone's attention to say the markets are going to go up faster, right? But that does actually have a meaningful impact, and it does speak to the characteristic of including positive convexity in portfolios as well. Now, as Gary pointed out at the start, and again in our conversations offline, the vast majority of people that have money in markets are older, almost by definition, right? There's such an incredibly positive correlation between age and financial asset accumulation that the industry has to focus on that. And so there's a natural focus on that downside, but you cannot ignore the fact that the market structure is changing it towards higher as well.
Sorry.
I was just gonna say, when the herd gets moving, and again, a lot of these individuals, we're all human beings, right? And so when it feels great when the market goes up, and everyone, you can't buy fast enough, right? I mean, that was in the 90s, we were getting complaints that we couldn't get invested fast enough. The flip side of that is also true, that when everyone bails at the same time, this is going to be a very, very difficult time to try to hedge risks.
Well, one of the things that's happening in the background on those flows as well is if you look at the inflows, we're still seeing outflows from mutual funds, particularly actively managed mutual funds, right? And that has all the hallmarks of the boomer and silent generation retirement, taking the distributions and liquidation from their underlying portfolios, right? So the money that is coming in, there was a rule change. People have heard me refer to this. There's a rule change that took effect on January 1st this year that dramatically enhanced the ability, in particular for small businesses, to offer retirement plans for their employees, with huge benefits for the owners of the business themselves. It expanded the quantity of capital that could be withheld in a tax-deferred account from roughly $50,000, $57,000 to be precise, to somewhere in the neighborhood of $250,000. And if you happen to have your spouse involved in the business, you can put up to $500,000 into a tax-deferred account. On my analysis, that's been the lion's share. That's been the single biggest driver of the flow of capital into the markets on a year-to-date basis. The question is, what does the second half of the year look like as we begin to see the retirement accounts draw out again? And it's very unusual to see this level of flows. Maybe it continues, maybe it doesn't. But in my view, it's important to pay attention to both sides of that.
So given kind of retirement accounts, given that our industry has a bias towards, as people age, cranking up their fixed income exposure. Harley, what's the larger part of the iceberg under the water within the fixed income world, and how do we think about convexity within the fixed income world in regards to protection against the potential for rising rates?
The answer is what? I mean, I think the biggest problem right now is that the Fed is buying bonds, and as long as they're buying bonds, you can't fight them. This is the focus of my last piece over here. Is it's been a decade of rising, of massive inflation, but in financial assets as well as some hard assets, also like housing and gold or art or that kind of stuff. But what you haven't seen is an increase in labor, in wages, which was the public policy idea in the very beginning. And the Fed is going to keep trying the same, using the same screwdriver in the wrong place by pumping more and more money in, and it's not working that way. Now, fiscal policy might change the game because that's going to put money into people's hands who spend it, as opposed to money into people like my hand who save it. Will that occur? It's unclear. I kind of view it as basically being, two hurricanes coming at the same time, between fiscal policy coming at the same time, the demographic boom or inflection is coming this way. But there's nothing to say about convexity per se for fixed income, except that rate options are extraordinarily cheap. I mean, the MOVE index is 61 right now. I mean, the VIX has been, 16, 17 for the last 6 weeks on average, notwithstanding we're at 19 right now. I mean, volatility is extraordinarily low. What's more interesting actually is that 1 month, 3 month, 6 month options, vol being low, whatever. Okay, the Fed's not is going to protect us for now. What's amazing is that very long dated options, 5-year, 7-year, 10-year options, are extraordinarily inexpensive. And if you look at term surfaces, so the implied vol of a 1 month after a 10-year used to be a very steep slope. It is now flattened out in most markets, bond, equity, foreign exchange, which is kind of silly because we've been cranking up the gears, the spring action here, you should see longer dated vols going up as greater uncertainty becomes apparent. The fact that I can get to a tussle with Mike or Dave Rosenberg or Lacey Hunt about this various stuff, and it gets more and more heated each time, tells you that there's more and more uncertainty out there, and uncertainty is, transits into option prices, bigger distribution, bigger flow of outcomes. So it's a lot of options that are kind of strange in my view, and that's where the value add prospect is of buying convexity in rates.
Well, and I would just emphasize that, while Harley and I ultimately disagree in terms of the probability of rates rising to the level that would create those concerns, I do think I completely agree with Harley that the pricing of those risks currently is quite low, right? And so the idea of buying a hedge against a low probability event when it is priced as a low probability event, but has significant magnitude associated with if the event actually occurs, strikes me as a very prudent choice, right? So Harley and I can disagree on that, while at the same time we agree on implementation components, which tends to be the best possible outcome.
All right, beautiful. So we are at the hour mark. So I want to thank everyone for joining us today. And Gary, thank you so much for participating in this discussion. It was really wonderful. So hopefully we're going to make this available via replay. We'll see how our compliance department is feeling about everything, but I think we managed to avoid any landmines. So hopefully over the next couple of days, we'll make this available. And then we'll have our next discussion next month, August 12th, same bat channel, same bat time. Discussion will be on inflation and commodities. We're going to have Mike Ashton on, who's a commodities expert. So please reach out to us at simplify.us if you have any questions or if you'd like to learn more. Have a great day, and thanks again for joining us.